HMRC alert. If you have £10,000 plus in savings, this could hit your pension payments hard. I'm revealing the latest HMRC updates and what the UK pension crisis means for your money. Stay with me till the end to learn exactly how to protect your savings. This channel is made just for people like us, so subscribe now and never miss critical updates that could save you thousands. I want you to stop what you're doing for just a moment, because if you have £10,000 or more sitting in a savings account right now, what I'm about to share with you could save you from an unexpected and very unwelcome letter from HMRC. This isn't clickbait, this isn't scaremongering, this is a real active warning that is affecting thousands of ordinary savers across the UK right now, and the frightening part is that most of them have no idea it's coming until it's already too late. Let's start from the very beginning, because to understand why this warning matters so much in 2026, you need to understand what's changed in the last few years and why the rules that were once a distant concern for most everyday savers have suddenly become very relevant indeed. Cast your mind back to 2021. Interest rates were rock bottom. You could have had £100,000 sitting in a savings account and barely earned enough interest to buy yourself a decent lunch. Nobody worried about tax on savings interest back then because there was barely any interest to speak of. But then came the inflation crisis. The Bank of England started hiking interest rates aggressively, and suddenly savings accounts that had been practically dormant for years started generating real, meaningful returns. People who hadn't thought about their savings interest in decades suddenly found themselves in unfamiliar territory, earning hundreds, sometimes thousands of pounds in interest each year, often without realizing what that meant from a tax perspective. Now, here's where it gets really important. HMRC has a system, and that system is far more sophisticated than most people realize. Every bank and building society in the UK is legally required to report the interest you earn directly to HMRC. You don't have to do anything. You don't have to fill in a form. Your bank does it automatically every single year, and HMRC receives that information quietly and efficiently while you carry on with your life none the wiser. This has been the case for a long time, but it matters enormously right now because higher interest rates mean more people are earning more interest, and that means more people are crossing the thresholds that trigger a tax obligation. HMRC isn't just sitting on this data, they're actively using it to issue warnings, adjust tax codes, and in some cases send out tax bills to people who didn't even know they owed anything. So what exactly are these thresholds, and how do you know if you're at risk? The starting point is something called the personal savings allowance, and this is the piece of the puzzle that most people either don't know about or don't fully understand. The personal savings allowance was introduced back in 2016, and it was genuinely good news at the time. It meant that basic rate taxpayers, those paying 20% income tax, could earn up to £1,000 in savings interest every single year, completely tax-free. Higher rate taxpayers, those in the 40% bracket, got a slightly smaller allowance of £500. And for those earning above £125,140 a year, the additional rate taxpayers, the allowance disappears entirely, and every single penny of savings interest they earn is potentially subject to tax at 45%. These allowances have not changed since the day they were introduced, and that is precisely the problem. Think about what that means in practical terms. When the personal savings allowance was created, interest rates were so low that a basic rate taxpayer would have needed roughly £250,000 in savings just to use up their full £1,000 allowance. That felt like an enormous, almost theoretical amount for most ordinary people. But fast forward to today, with savings rates that have been sitting at 4, 5, even 6% in some accounts over the past couple of years, that same £1,000 allowance gets used up with a pot of just £20,000 to £25,000. Suddenly a threshold that seemed designed to protect almost everyone is actually catching an enormous number of perfectly ordinary savers, people who've simply done the sensible thing and put money aside, and they're finding themselves with an unexpected tax liability they hadn't planned for. Now, there is an additional rule that HMRC has been highlighting very specifically, and this is the one you absolutely need to pay attention to if your total savings interest for the year crosses £10,000. If your savings and investment income exceeds £10,000 in a single tax year, you are required by law to register for and complete a self-assessment tax return. This is not optional. It doesn't matter if you've never done a tax return in your life. It doesn't matter if you're a payee employee whose taxes are all handled automatically through your payroll. Once you cross that £10,000 interest threshold, the responsibility shifts to you to declare it. The deadline to register for self-assessment is the 5th of October following the end of the tax year in which you cross the threshold, and if you miss that deadline, penalties start building up almost immediately. For most people with modest savings, reaching £10,000 in annual interest requires a fairly substantial pot of money. At current rates of around 4%, you'd need roughly £250,000 in savings to generate that level of interest income. But this isn't just about people with £250,000 sitting in the bank. It applies to anyone who has multiple savings accounts, investment income, peer-to-peer lending returns, or a combination of different income sources from savings that together push them over that line. And there are people in exactly that situation all across the country right now who have absolutely no idea they're supposed to be filling in a tax return. What makes this even more complex and frankly more concerning is the way that frozen tax thresholds are interacting with rising incomes, particularly for pensioners. The personal allowance, which is the amount of income anyone can earn before paying any income tax at all, has been frozen at £12,570 and will remain frozen until at least 2028. The state pension has continued to rise under the triple lock. For many pensioners, their state pension alone is now eating into a significant chunk of that personal allowance, leaving very little tax-free space for anything else. Add in some savings interest from a pot they've built up over a lifetime of careful saving, and suddenly a retired person who never expected to have a significant tax bill is finding themselves in the higher rate bracket or losing their personal savings allowance altogether. HMRC's own data suggests that pensioners account for almost half of all taxpayers currently receiving bills for savings interest, and that figure is only going in one direction. So what happens if HMRC decides you owe tax on your savings interest? In many cases, they'll simply adjust your tax code. If you're a PAYE employee or you receive a pension through payroll, HMRC can change the number in your tax code so that slightly more tax is taken from your regular income to cover what you owe on your savings. It sounds tidy, but it can cause real problems if you don't understand what's happening. People suddenly notice their take-home pay has dropped and don't know why, or they receive a letter from HMRC that they find confusing and intimidating. In more complex cases, or when you've been earning significant savings interest that hasn't been reported through a return you were supposed to be filing, HMRC will issue something called a simple assessment or a more formal demand for payment. Ignore it, and the penalties start compounding. HMRC can charge you up to 30% of the unpaid tax as a penalty on top of the original amount owed, and interest begins accruing on unpaid amounts from the day the tax became due. The key question everyone wants answered is what they can actually do about all of this, and the good news is that there are genuinely powerful options available to almost every UK saver. The most important tool at your disposal, and the one that financial experts return to again and again, is the individual savings account, the ISA. An ISA is a completely tax-free wrapper for your savings and investments. Any interest you earn inside an ISA does not count toward your personal savings allowance, does not get reported to HMRC as taxable income, and does not factor into the £10,000 self-assessment threshold at all. It simply doesn't exist from a tax perspective. For the 2025 to 26 tax year, every UK adult is allowed to put up to £20,000 into ISAs, and that allowance resets on the 6th of April each year. Critically, it's a use it or lose it allowance, meaning if you don't use your £20,000 of ISA allowance before the 5th of April 2026, that specific year's allowance is gone forever. You cannot carry it forward. So if you've been sitting on savings outside an ISA and you haven't yet used this year's allowance, the clock is ticking. There's also an interesting combination of allowances that is genuinely life-changing for people with low non-savings income, particularly retirees or part-time workers. Alongside the personal savings allowance, there exists something called the starting rate for savings, which allows you to earn up to an additional £5,000 in savings interest at a 0% rate. The catch is that this starting rate tapers down by £1 for every pound of non-savings income you earn above your personal allowance. So if your only income is from a part-time job bringing in £13,000 a year, you've used up £430 of your starting rate band already, leaving you with £4,570 at 0%, plus your standard personal savings allowance on top. Add all three together, and it is possible for the right person in the right circumstances to earn up to £18,570 in savings, interest completely tax-free in a single year. That's a number worth pausing on, because it's a genuine opportunity that a huge number of eligible people are simply not aware of or not taking advantage of. Another often overlooked strategy is making use of your partner's or spouse's ISA allowance and savings capacity if they are in a lower tax band than you. If you are a higher rate taxpayer and your spouse is a basic rate taxpayer, holding more of your joint savings in their name means the interest falls under their more generous personal savings allowance and potentially their starting rate band too. This isn't tax avoidance in any controversial sense. It is entirely legitimate tax planning that HMRC's own rules are designed to accommodate. Similarly, quickly. Premium bonds from National Savings and Investments are worth a mention here because any prizes you win are entirely tax-free and don't count toward any of the thresholds we've been discussing. The effective interest rate you get from premium bonds depends entirely on the prize fund rate and how lucky you are. But for large savers looking for a simple government-backed tax-neutral option, they remain a reasonable part of the conversation. One of the most important practical steps you can take right now today is to log into your HMRC personal tax account. This is free, it takes about 10 minutes to set up if you haven't done it already, and it gives you direct access to what HMRC holds on you. You can see the interest figures your banks have reported, check what tax code you're currently on, and spot any discrepancies between what your bank has told HMRC and what you've actually earned. Given that banks sometimes make reporting errors, particularly after mergers or system changes, it's genuinely worth checking. Catching an error on your own terms is infinitely better than waiting for HMRC to write to you about it. From there, gather all your annual interest statements from every savings account you hold, add them up, and compare the total against your relevant allowances. If you think you may have crossed a threshold, speak to a qualified accountant or tax advisor. The cost of professional advice is almost always less than the cost of penalties and interest for getting things wrong. What we're seeing right now is the convergence of several forces that have made savings tax a live issue for millions of people who never expected to worry about it. Higher interest rates, frozen allowances, rising state pensions, and increasingly sophisticated HMRC data collection have combined to create a perfect storm. The tax rules themselves haven't dramatically changed. What has changed is the environment in which they operate, and the result is that ordinary, responsible savers are finding themselves caught in a system that was previously only relevant to the wealthy. That's not fair, but it is the reality, and the only sensible response is to understand the rules, know where you stand, and take action before HMRC takes it for you. If there's one thing to take away from everything we've covered today, it's this. Don't assume that because you've never had to think about savings tax before, you don't need to think about it now. The rules have always been there. What's changed is that rising interest rates have made them relevant to far more people than ever before. Check your savings interest totals for this tax year. Check whether you've used your ISA allowance. Check your HMRC personal tax account. And if in doubt, get proper advice. The 5th of April 2026 is approaching, and once that date passes, this year's ISA allowance and this year's tax position are locked in. There is still time to act, but that window is closing. Don't be the person who finds out too late.